Gold has occupied a unique position in human civilization for thousands of years. It is more than a metal, more than a commodity, and more than a decorative material. Across history, gold has functioned as money, as a store of value, as a symbol of power, and as a foundation for trust between societies. In the modern global financial system, gold no longer circulates as everyday money, yet it remains deeply embedded in the relationships between nations, institutions, and markets. To understand global finance without understanding gold is to overlook one of the most persistent anchors of economic psychology and international trust. In ancient societies, gold emerged naturally as a medium of exchange. Its physical properties made it suitable for this role. It does not corrode, it is divisible, it is relatively rare, and it is easily recognizable. These qualities allowed gold to become a shared reference point across cultures that had little else in common. Long before formal banking systems existed, gold facilitated trade between distant regions. Merchants trusted gold because its value did not depend on the authority of a single ruler or city. This early trust laid the groundwork for later financial systems that relied on shared standards. As empires expanded, gold became closely linked to state power. Control over gold mines often translated into military and political dominance. The Roman Empire, for example, used gold coinage to pay soldiers and administer vast territories. The value of the currency depended on the purity of the gold, and any debasement weakened confidence. This relationship between gold and trust revealed an early truth of finance. Money is not only a tool of exchange but also a promise. Gold strengthened that promise because it carried intrinsic value independent of political declarations. During the medieval period, gold continued to play a central role in international trade. Islamic caliphates, European kingdoms, and Asian empires all recognized gold as a universal measure of wealth. Trade routes such as the Silk Road moved not only goods but also gold itself. Financial relationships between regions were shaped by the flow of precious metals. Areas that accumulated gold gained influence, while regions that lost gold often experienced economic strain. These dynamics created early versions of balance of payments concerns that still exist today. The modern era transformed gold from circulating money into a reserve asset. The gold standard emerged as a formal system that linked national currencies to fixed quantities of gold. Under this system, governments promised to exchange paper money for gold at a specific rate. This created a global financial order based on stability and predictability. Exchange rates between countries were effectively fixed, and international trade expanded under the assumption of monetary reliability. Gold served as the ultimate settlement asset between nations. However, the gold standard also imposed strict limits on economic flexibility. Governments could not easily expand their money supply without sufficient gold reserves. During periods of war or economic crisis, these constraints became problematic. The First World War forced many countries to suspend gold convertibility in order to finance military spending. After the war, attempts to return to the gold standard created tensions and deflationary pressures. These struggles revealed a fundamental conflict between gold-based discipline and modern economic management. The collapse of the gold standard during the Great Depression marked a turning point in global finance. As economies contracted, adherence to gold convertibility worsened unemployment and reduced policy options. Countries that abandoned the gold standard earlier often recovered faster. This experience reshaped economic thinking and contributed to the rise of managed currencies. Gold no longer defined money directly, but it remained central to reserves and international confidence. After the Second World War, a new system emerged that balanced gold with fiat currency. The Bretton Woods system linked major currencies to the United States dollar, which in turn was convertible to gold. This arrangement placed gold at the heart of global financial relationships while allowing greater flexibility. The United States held large gold reserves and acted as the anchor of the system. Other nations trusted the dollar because of its gold backing and the economic strength of the United States. Over time, however, imbalances developed. As global trade expanded, the supply of dollars grew faster than the supply of gold. Foreign governments began to question whether the United States could honor its gold commitments. In 1971, the convertibility of the dollar into gold was suspended. This decision effectively ended the Bretton Woods system and ushered in the era of floating exchange rates. Gold was officially removed from its role as the foundation of international currency, yet it did not lose its relevance. In the post-Bretton Woods world, gold assumed a new function. It became a financial asset rather than a monetary standard. Central banks continued to hold gold as part of their reserves, not because it backed their currencies directly, but because it provided insurance against uncertainty. Gold does not depend on the creditworthiness of any government. This quality makes it uniquely valuable in a system built largely on trust in institutions. Global financial relationships today are complex networks involving trade, capital flows, debt, and monetary policy. Gold operates within this network as a stabilizing reference point. When confidence in currencies weakens, demand for gold often increases. This pattern reflects a deep psychological association between gold and safety. Investors view gold as a hedge against inflation, currency devaluation, and geopolitical risk. These perceptions influence capital movements across borders and shape financial relationships between countries. Central banks play a crucial role in the modern gold market. Their decisions to buy or sell gold signal broader strategic intentions. When emerging economies increase their gold reserves, they often seek to reduce dependence on dominant reserve currencies. This behavior reflects concerns about sanctions, financial sovereignty, and long-term stability. Gold becomes a tool of geopolitical strategy as well as financial management. The distribution of gold reserves across countries can reveal shifting power dynamics in the global system. The relationship between gold and the United States dollar remains particularly significant. Although the dollar is no longer backed by gold, it still dominates global trade and finance. Gold prices are often quoted in dollars, and changes in dollar strength influence gold valuation. When the dollar weakens, gold prices tend to rise, reflecting a search for alternative stores of value. This inverse relationship illustrates the ongoing dialogue between fiat currency dominance and gold-based security. Developing economies often view gold differently from advanced financial centers. In many countries, gold plays an important cultural and social role. It is used for savings, dowries, and intergenerational wealth transfer. These practices create steady demand that is less sensitive to short-term price movements. This cultural dimension adds another layer to global gold markets. Financial relationships between gold-producing countries and gold-consuming societies shape trade balances and investment flows. Gold production itself influences international economics. Mining activities are concentrated in specific regions, and production costs vary widely. Countries rich in gold resources can benefit from export revenues, but they also face challenges related to environmental impact and economic dependence. Global gold supply responds slowly to price changes, which contributes to long-term price stability but also creates cyclical effects. These supply dynamics interact with financial demand to shape the global gold market. Financial innovation has further transformed the role of gold. Exchange-traded funds and digital trading platforms allow investors to gain exposure to gold without physical ownership. This financialization increases liquidity and accessibility, but it also introduces new forms of volatility. Gold becomes intertwined with broader financial markets, responding to interest rates, risk sentiment, and speculative behavior. These connections reinforce the integration of gold into global financial relationships. Despite these changes, physical gold remains important. Central banks and long-term investors continue to value tangible reserves. Physical gold represents certainty in a world of abstract financial claims. In times of crisis, when trust in institutions erodes, physical assets regain prominence. Historical episodes of financial stress often coincide with increased gold accumulation. This recurring pattern underscores the enduring relevance of gold as a stabilizing force. The role of gold in inflation dynamics deserves attention. Gold is often described as a hedge against inflation, although this relationship is complex. Over long periods, gold tends to preserve purchasing power, but short-term movements can be unpredictable. Inflation expectations influence gold demand, which in turn affects financial flows. Countries experiencing high inflation may see increased domestic gold demand, affecting imports and currency stability. These interactions illustrate how gold connects domestic economic conditions to global markets. Geopolitical tensions further amplify the importance of gold. Sanctions, trade disputes, and conflicts can disrupt financial systems. In such environments, gold serves as a neutral asset that is difficult to control or freeze. This characteristic makes gold attractive to states seeking to protect their reserves from external pressure. The accumulation of gold by certain countries reflects broader shifts toward financial independence and multipolarity. The future of gold in global finance is shaped by uncertainty. Technological change, digital currencies, and evolving monetary frameworks challenge traditional assumptions. Some argue that gold will gradually lose relevance as new forms of value storage emerge. Others believe that gold will remain indispensable precisely because of its physical nature and historical credibility. These debates highlight the symbolic as well as practical dimensions of gold. Gold also plays a role in shaping expectations. Market participants often interpret gold price movements as signals about economic health. Rising gold prices may indicate fear or uncertainty, while declining prices may suggest confidence in growth. These interpretations influence behavior, reinforcing feedback loops within financial markets. Gold thus functions as both a reflector and a driver of sentiment in global finance. Environmental and ethical considerations are increasingly relevant to gold production and trade. Mining practices raise concerns about sustainability, labor conditions, and ecological damage. These issues affect investment decisions and regulatory frameworks. Financial institutions incorporate environmental criteria into their assessments, influencing capital allocation within the gold industry. This evolving context links gold to broader discussions about responsible finance. Education and perception also matter. Public understanding of gold influences political and economic choices. In some societies, gold is seen as outdated, while in others it is deeply trusted. These attitudes shape saving behavior and policy debates. Gold occupies a unique position at the intersection of tradition and modernity, science and belief, material reality and abstract value. In conclusion, gold remains a foundational element of global financial relationships despite profound changes in monetary systems. Its role has evolved from direct monetary backing to strategic reserve asset and psychological anchor. Gold connects past and present, linking ancient trade practices to modern financial networks. It influences trust between nations, shapes investor behavior, and reflects deeper anxieties about stability and power. As long as uncertainty exists in the global system, gold will continue to play a meaningful role in the architecture of international finance.